Welcome, everyone. I'm Barbara Eklund, Vice Chair Green Christian. So welcome on behalf of Green Christian to the first in our new series of Joy in Enough monthly talks. And delighted to say that Rev Dr John Daniels is going to be talking tonight. John has been a member of the Joy in Enough enabling group for a good number of years and was one of the key people in planning our recent conference. He was, I understand, a research scientist and then became an Anglican priest with senior positions at diocesan level. And as those who watched the Paul Kingsnorth talk will know, he's a very good communicator. So I'd like you all to mute yourselves now if you haven't already done so. And during the course of the talk, if you want to put questions in the chat, we can then pick up on them. But I'm going to hand over to John now, who's going to talk about money, where it comes from, and where it's going. So, John, over to you.
Thank you very much, Barbara. Thank you very much. Can you all hear me okay to start with? Excellent. Very good. In which case, I will share my screen with you. There we go. Right. Yeah, so good evening, everyone. It's very good to be with you this evening. And as Barbara said, the theme for this evening is money, where it comes from, where it's going, and why it's all about faith. And at the start, I want to acknowledge the support of the Montgomery Trust in giving this talk. So there's a lot to go through this evening, and although I will touch on faith towards the end, I'm not going to be able to spend a great deal of time on it. But what I would suggest you might want to do in the course of the presentation, if you've got a pen and paper handy, whenever we come across any reference to faith, or any similar related ideas like trust or promise or belief, just make a note of that, because at the end what I'll be trying to do is to connect up some of the ways in which faith runs through the way money works, like Blackpool through the proverbial stick of rock. And as I said, there are going to be quite a lot of slides, I'm afraid, so I'm going to tear through them at quite a lick. So if there's anything that you want some more detail about or some clarification of, do please put requests for that in the chat, as well as any other more general questions that occur to you. And I'll try to deal with as many of those as I can at the end of the talk. So without further ado, let's crack on. So we're going to start off by looking at where money comes from. And to do that, I want to begin with a simple question, which is, when your bank makes you a loan for a mortgage or business loan, whatever it might happen to be, when your bank makes you a loan, where does that money come from? And here's a selection of possible answers. Does it come from money that's been deposited in the bank by other people and companies? Has it been lent to the bank by the Bank of England? Is it a part of the dividends from Queen Anne's bounty? Is it created out of thin air? Or does it come from Jeremy Corbyn's magic money tree? Some of us may remember Jeremy Corbyn and indeed his magic money tree. Well, the answer, I wonder what you'd say the answer was. The answer is actually that it's created out of thin air by the bank. You may notice that the word source has suddenly appeared there several times at the bottom. And that's to remind me to tell you that there is a PDF version of this presentation available on the Joy in Enough website. I would encourage you to have a look at that. And if you click on whenever you see the word source, you'll be taken to a source which is relevant to whatever's shared on that particular slide. And as I said, do chase some of those up if you want to. So money created out of thin air by the bank, how on earth does that work? Well, it all goes back to the 17th century. The roots of this practice lie there. At that time, goldsmiths had become very important figures, because people used to commonly deposit their valuables in the goldsmiths' vaults. The goldsmiths would, of course, issue a receipt, a deposit receipt in return. And of course, these receipts were, when you think about it, a form of IOU. Three really important developments followed from this. First, over the course of time, people began to accept these deposit receipts, or IOUs, as a kind of form of cash or a means of exchange in everyday purchases. A bit like we used to do with endorsed checks back in the day. And I think you probably still can technically. Secondly, goldsmiths realized that they could lend out some of their gold and silver, which they held on deposit, and they moreover could charge interest to the borrowers in doing so, because I mean the gold and silver was just sitting there in their vaults doing nothing otherwise. And finally, the goldsmiths also realized that since their deposit receipts were now being widely accepted as cash, borrowers would be prepared to accept loans issued in the form of these receipts rather than insist on coinage. As a result, goldsmiths were able to issue receipts for more coinage than they actually held. After all, who would the difference? Provided people trusted the goldsmith, that is, they believed that he held enough hard currency in the form of gold and silver to cash in a given receipt, everyone was happy. And so these are the origins, in this country at least, of the practice of what's called fractional reserve banking, which is the practice of lending out more money, effectively in the form of IOUs, than you actually hold. And this extra money is created out of thin air. So the banks, who are the modern day equivalent of the goldsmiths, effectively have a license to print money. An example of that would be going back to 2008, the time of the great financial crash. Commercial banks in the UK held just £1.25 in central bank reserves for every £100 that they had loaned out to customers. Now, if you're shocked by that, you wouldn't be the first, and you wouldn't be alone. Lord Stamp, a former Bank of England director, once said that the modern banking system manufactures money out of nothing. The process is perhaps the most astounding piece of sleight of hand ever invented. J.K. Galbraith was similarly unimpressed. And Henry Ford, the man who gave us the motor car, is reputed to have said on one occasion, "It is well enough that the people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." And the Bank of England is all tied up at the origins of this, because back in 1694, a group of wealthy merchants lent King William III, William of Orange, of William Mary fame, £1.2 million, which back then was a very decent sum of money to spend, inevitably, on war. Kings and governments have always been more than willing to do that, sadly, and as is traditional, of course, against the French. And this sum was lent at an interest of 8% per annum, which back then, and even more so now, would look pretty tasty. Now, in return, the king's creditors were allowed to create their own private bank, but with unique public privileges. And this is what became the Bank of England. David Graeber, in his excellent book Debt, The First 5,000 Years, describes the process in this way. The investors received a royal monopoly on the issuance of banknotes. What this meant in practice was that they had the right to advance IOUs for a portion of the money the king now owed them to any inhabitant of the kingdom willing to borrow from them or willing to deposit their own money in the bank. In effect, to circulate or monetize the newly created royal debt. And this is just a kind of schematic which outlines kind of how the business plan worked. I'm not going to go through it in detail, but what I do want to point out to you is the blue line there on the left labels customs and excise or tax. That was a crucial ingredient of the business plan, because where the government got the 8% annual interest from was from taxation levied on the general population. So you can see there straight away, I think, rather neatly, the way in which wealth is taken from wider public and funneled via the government and the bank down to a narrow band of investors. If memory serves, there were just over 1,000 investors in there at the very beginning. Yeah, 1,272 shareholders. So again, do look at the PDF of the presentation if you want to kind of look through the detail of that at your leisure. So this is why the Bank of England notes, like this fiver, which I have procured at great cost to demonstrate to you this evening, notes like this still bear the legend, "I promise to pay the bearer on demand the sum of £5 or whatever," because it is a mere IOU. That's all this is in essence. And as an IOU, it reflects a relationship between people. So the chief cashier, representing the Bank of England, and so indirectly the state, and the state's creditors, those from whom the state has borrowed, and finally, of course, you and me, the bearer of the IOU. What we see here is what one writer has described as the integration of the state and the creditor class. And the Bank of England was one of the pioneers in making this happen. It's a model which has since expanded across the world, really, as a way of running national economies. It also reflects the credit theory of money, whereby money simply means a social bond of credit and debt. Money doesn't need to have any value intrinsically. It's just a claim on the wealth of others, an IOU. And that's why it can take the form of a piece of paper. This isn't this is a polymer, isn't it? Not paper these days, I think, technically, or increasingly these days, just a ledger entry, either on a piece of paper or virtually a set of digits sitting in a computer somewhere. And any of you who listened to the talk I gave on where money comes, on what money is, about a year ago, will remember I mentioned that the credit theory of money is one of three theories that does the rounds, each of which I think has some insight to offer, so along with the commodity of theory of money there, and the so-called state theory of money, where money is understood in terms of taxation. And again, the original business model of the Church of the Bank of England, sorry, not the Church of England, the original business model of the Bank of England illustrates that rather well. Okay, so that was the history. But where does money come from today? Let's bring things up to date. Now, this is going to get a little bit more technical, so put your thinking caps on, but hopefully it will kind of make sense as we go through it. The crucial thing to understand about money today is that there is more than one kind of money in circulation at any given time. In fact, there are three, you could say. And remember, all this money that's in circulation is money that's been loaned into circulation. Okay, so it represents a debt. And that's a crucial thing to realize. Now, two of these forms of money are created, loaned into existence by the Bank of England, in our case, or central banks more generally. And the third kind is loaned into existence by commercial banks. So that's whoever you bank with, whoever I bank with. So to begin with, the first kind of money is the most familiar one to us. It's physical cash, that's notes and coins. And these are produced by the Bank of England or the Royal Mint in the case of coins on behalf of the bank, and it circulates widely. We kind of understand that, don't we? But also, the Bank of England loans into existence digital money, which it uses to put into the reserve accounts of the national government, but also of commercial banks. So all our commercial banks, Lloyds, NatWest, you name them, they've all got reserve accounts at the Bank of England. And the point of those accounts is that it's one of the chief ways in which those banks can settle their accounts with each other. Because at the end of the day, there's been any number of transactions that have taken place between individuals who bank with different banks. So there has to be a kind of a clearing process when those accounts are settled. And it's by means of the reserves that are held at the central bank that happens. And there is also a separate reserve account, obviously, which the national government holds. Commercial banks, on the other hand, also generate digital money as deposits for you and me and for various non-financial companies. And these are all, as I suggested, really technically IOUs. Cash represents an IOU from the cashier of the Bank of England. The deposit accounts that you and I hold in our commercial banks are IOUs from the commercial bank, from Lloyds, from NatWest, from Barclays to us. And the reserve accounts held by the commercial banks represent IOUs from the central bank to the commercial banks. And they've all been loaned into existence. That's the key thing to remember. So how do these work? Well, let me just share a couple of quick slides which show how these three different sorts of money inhabit three different circuits. They don't really mix, and that's crucially important. So cash, we know how cash works, and that basically does a circuit which originates from the central bank. It goes through my pocket and your pocket, and eventually it ends up through taxation and so forth back in the central bank's coffers again. And completely separate are the two circuits which show how the reserve accounts of the government and the commercial banks work. These are the grey and the black arrows here. Again, the money does not mix. These circuits are closed. That's a crucially important thing to realize. And finally, commercial bank money is a separate circuit again, and it involves companies and individuals and the commercial banks. Now, you may be thinking, well, hold on, the money I've got in my bank account, I didn't borrow that. You know, I earned that through the sweat of my brow. But the reality is that that money was loaned into existence at some point in the past to somebody, years and years ago, potentially. And it's kind of, because of the various transactions that go in the economy, through the economy, it's ended up in your bank account now. So when you actually go to a cash point and extract some money, what actually is happening there is that you're swapping some of that digital commercial bank money for some cash which the commercial bank had to purchase from the Bank of England in order to be able to disgorge it from its cash point when you typed in your PIN. Sounds a curious way to operate, doesn't it? Really, needlessly complex, but this is intrinsic to the way the modern money system operates, and it's really crucial to register this. So, how much of this money is swishing around in the economy? Well, let's start by looking at cash again. And I've gone all the way back to 1963 because that's as far back as the Bank of England records go. And as you can see, the amount of cash circulating in the economy has increased quite a bit over that time. It's getting on for £100 billion now. A billion is, of course, 1,000 million. And as we'll see in a moment, it's increased more or less in line with inflation. Okay, so in terms of spending power, the amount of cash in circulation has remained roughly constant over the course of these last getting on for 60 years. Now let's add in commercial bank reserves. This is money, remember, that's been created by the Bank of England for commercial banks and sits in accounts at the Bank of England itself. Wow, look at that. Notice the yellow line there again. I've tried to be consistent in my color coding. The yellow line is again cash in circulation, which, as we noticed before, is just shy of £100 billion. Well, my goodness, these days commercial bank reserves are 10 times that value. There's almost £1 trillion these days held in commercial bank reserves. Now that's really weird because, remember, the point of those commercial bank reserves is simply to act as a kind of a slush fund, a kind of a float, if you like, by means of which different commercial banks are able to settle their accounts with each other at the end of the day. Now, up until 2006, they were able to do that with only about £1 billion sitting cumulatively in those reserves. That increased somewhat in 2006 because the Bank of England started to pay interest. So we went up to about 20 or 30 billion at that point, but it was fairly steady until, of course, 2008 came along and we had the great financial crash. And since then, for a couple of reasons, which I can go into if you like, the Bank of England has been loaning into existence more and more money, which has ended up, in a sense, in the reserve accounts of commercial banks in order to keep our economy afloat. As you can see, it's happened in various tranches. You can see the steps in the black line there as it goes up. And the last one, when the amount of money in commercial bank reserves pretty much doubled from 500 to 1,000 billion pounds was, of course, what happened in 2020 with the response to the pandemic. An astronomical amount of money. But we ain't seen nothing yet. Because here, I've added in a third line, and this is what's known in the trade as broad money. And basically, this is the money that you and I are familiar with. Essentially, it's cash plus the commercial bank money that you and I hold in our bank accounts. So the orange line there includes, in effect, the yellow line as well. And if you thought that commercial banks have got a lot of money sitting in the central bank, then look at the amount of money that's sloshing around in the wider economy. And remember, this is all money that has been loaned into existence. It is all outstanding debt. When a loan is issued, the amount of money in circulation increases. When a loan is paid back, that money disappears because it's only an entry in a ledger. It simply gets deleted. So the fact that that orange line carries on growing for the most part during this 60-year period is an indication of the fact that the rate at which new debt is being taken out exceeds the rate at which old debts are being repaid. And you can see there, it's only in 2008, with the great financial crash, that there was a grand deleveraging, a grand repayment of debts. And for a while, that line went flat for a few years until about 2014, when the process of lending more and more money to circulation started again. That is a huge, huge increase in debt. £3 trillion. That's where we're north of now, so far as broad money sloshing around in the economy is concerned. And just quickly to kind of illustrate how this works, I've included here a comparison with a various series of other indicators, just to give you a sense of how enormously broad money has increased. So starting from the bottom there, first of all, you've got the blue line. Now that's the retail price index. That's inflation, basically. So if prices were simply following, were simply growing at the rate of, if these other values were all growing at the rate of inflation, they would basically all be tracking that blue line. I've normalized all these values, by the way, because they come in different units, to a value of 100 in 1963. So they all started at 100 in 1963, and this is what's happened to them since. As you can see, the retail price index has increased by about 26 times, a factor of 26, during the course of this getting on for 60 years. The yellow line, cash in circulation, as I mentioned, has kind of pretty much kept pace with that. It's slightly higher than it is now. So we've got about 37 times more cash in circulation now than we had back in 1963. We then jump up to the green line, and that's gross domestic product, GDP. That's a kind of rough and ready measure of national income. And as you can see, that's increased at a faster rate. So our annual GDP now is about 83 times more than it was in 1963. So again, it's increased objectively much faster than inflation. And as you'll have noticed, so have house prices. This is the nationwide house price index. Again, that's pretty much tracked GDP, hasn't it? It's slightly higher now, but it's more or less on the same level. But what stands out, of course, is broad money in circulation. That's, for the most part, money that's been created as interest-bearing debt loaned into circulation by commercial banks. And you could argue, I think, that that gap between the orange line and the green line, between broad money and GDP, represents excess money which has been created in the economy at that over that period. GDP, for all its failings, is a measure of the productivity, the prosperity of our economy. So where's all this excess money gone if it hasn't actually gone into making the economy larger and our lives better in some objective sense? Where's it ended up? Well, this is the answer. Over the last, well, we would now say 50 years, because this is 10 years ago. Over the last 50 years, we've had no constraints on the creation of money, as we've just seen, and it has all been used to buy assets. That's houses, that's bonds, That's stocks and shares. This is Philip Coggan, financial journalist, talking on the Radio 4 program Start the Week 10 years ago. And again, I alluded to this in the talk I gave last year. So Coggan goes on, we've had this series of bubbles in which borrowed money has been used to buy houses, shares, whatever. And every time the result has been that the finance sector has expanded very rapidly. So Wall Street, which is to say the finance sector, now depends on the central bank, the Bank of England and other banks like it across the world, to prop up asset markets, keep prices high. Now this next sentence I've put in red because so much hangs on this. We've created more claims on wealth than we have created wealth itself. That is the problem. And he goes on in this interview, we're not going to pay these debts back. It just is not going to happen. So what might happen instead? Well, there are two possibilities, and they're not mutually exclusive over the course of time. The first is default, people just walking away from their debt, saying, sorry, can't pay, won't pay. You're not going to see the principal again. You're not going to see any interest again either. Now, the result of that would almost inevitably be the collapse of stock markets, bond markets, housing markets. The second option is inflation, which seems to have returned, doesn't it? Now, inflation from one angle is prices going up. From another angle, inflation is money losing its purchasing power, losing its value. And that can take two forms again. It can take the form of consumer price inflation. That's what we're seeing today. Every time we go to the supermarket, the prices are going up. But asset price inflation has been happening for some considerable time, for years. And that's the prices of houses and the stock market being inflated by the fact that there's so much credit been created by commercial banks and ended up going through those particular circuits in the economy. I like the way Fabio Vighi puts this. The choice here between debt and inflation is the choice between bleeding to death and suffering a heart attack. A heart attack is the default, the bleeding to death is the inflation. Or as Coggan put it, one way or another, something negative is bound to happen. And that just illustrates, again, what we all know. These are two different measures of inflation, CPI and RPI. And again, just in these last few months, it's gone into double figures, hasn't it, pretty much? Certainly RPI has shot up there. But what's different this time to occasions in the past, as recently as 1990, when we had inflation in double figures, is that back then, interest rates were higher than inflation, which meant that savers were still getting some kind of return on their savings. But of course, since 2008, the Bank of England base rate has been rolling along the carpet. It's not since 1694, when the Bank of England was created, has the base rate fallen below 2% until 2009. Now, it's just shot up just in these last few weeks, hasn't it, to just above 2% again. But what that means is that people who are in a position to save, people who are fortunate enough to do that, are seeing their savings lose their purchasing power all the time. And there's not a huge amount we can do about it, apart from stoke the inflation in asset markets by buying some more shares or buying some more property. So that's where we've got to. So where is money going, therefore? That's where money comes from. Where is it going? Well, here's an interesting person who has a very salient answer to offer this. This is Nouriel Roubini, who is one of the few economists credited with seeing the 2008 crash coming before it eventually materialized around us. So this is what he said last year in an article. As inflation rises over the next few years, central banks will face a dilemma. If they start phasing out unconventional policies and raising policy rates to fight inflation, they will risk triggering a massive debt crisis and severe recession. But if they maintain a loose monetary policy, they will risk double-digit inflation and deep stagflation when the next negative supply shocks emerge. Under these conditions, central banks will be damned if they do and damned if they don't. And many governments will be semi-insolvent and thus unable to bail out banks, corporations, and households. The doom loop of sovereigns, that's countries effectively, of countries and banks in the Eurozone after the global financial crash of 2008 will be repeated worldwide, sucking in households, corporations, and shadow banks as well. As matters stand, slow motion train wreck looks unavoidable. Forgive me for my indulgence there. I couldn't resist that picture. But Rubini's message is pretty clear and pretty depressing. So some people think, in fact, a lot of people think, that our current system has reached the end of the road, and we need what a lot of people call the Great Reset. We need to reset the system financially, and indeed more broadly than that. And at the heart of this Great Reset that's been discussed is central bank digital currencies. Over 100 countries worldwide are now investigating the introduction of these currencies, including the Bank of England. So what is a central bank digital currency, and how is it different? It's different because it would represent, if it gets introduced, a new kind of money. Do you remember earlier I mentioned there were 3 different sorts of money that we need to distinguish? Well, this would be a 4th sort of money. So it would be money which is generated by, again, loaned into existence by the Bank of England. But this time, rather than being there for the benefit of the government or for commercial banks, we as individuals, or companies as well potentially, for the first time, could actually have accounts at the Bank of England. Up until now, that's not been an option for anybody. Although these accounts could well be managed by a separate agent, but essentially they would be a liability of the central bank. And that's a key feature which underlies their rationale. They would sit in digital wallets, as these things are sometimes called, and potentially could be distributed to everyone as a universal basic income. So again, this just to give you an illustration, the CBDCs again would circulate in the loop I've illustrated here, effectively the same loop as cash does at the moment. The difference is that cash is physical, which means you can own cash in the sense of you can physically hold it and you can, put it under the mattress, you can save it. But central bank digital currency is by definition digital. It exists as a ledger entry digitally somewhere in the deep recesses of the Bank of England. That's how the situation will be if it is introduced. So again, you see what's similar to cash here, but also how it's importantly different. So what kind of features might we expect from a central bank digital currency? Well, I have no crystal ball, but from what I've read, these are some likely initial features at least. First of all, it will exist in an account held at the central bank, a bit like your existing commercial bank accounts, rather than being a token-based form of money, a bit like Bitcoin. Some people sometimes talk about crypto assets in relation to this, but actually cryptocurrencies work in a rather different way on a distributed ledger rather than being centralized in one particular place, as this almost certainly will be, I think. And in order, therefore, for this system to work, everyone who has an account at the Bank of England and uses CBDC will need to have a personal digital ID in order for the security to work. As I mentioned, although the accounts will technically sit on the balance sheet of the Bank of England, the accounts will probably be administered by payment service providers, which could include existing commercial banks. The money will enter circulation, CBDC will enter circulation probably initially in response to demand and via commercial banks, a bit like cash does at the moment, and will therefore circulate alongside commercial bank money and cash. And this is very important, I think. Potentially, at least, these funds could be interest-bearing, a bit like your existing commercial bank account, but unlike your existing commercial bank account, that interest could be negative. The reason for this is because people are concerned. Well, one of the reasons is because people are concerned that because the Bank of England is a safer place to put your money than commercial banks, there could be a bank run, and where everybody takes their money out of their commercial bank and tries to put them in the Bank of England. So there's a desire there to place a disincentive in keeping too much money in your CBDC digital wallet. So, for example, you might be charged a negative interest rate if your balance exceeds a certain figure. I mean, £2,000, I've given an illustration here. So Bickers and Livingstone in their report, Money We Trust, make, I think, a crucial point at this juncture. The ability of the central bank to control the impact of a CBDC on the monetary system is paramount to its existence and its appeal. The central bank's control, I think, is a crucial ingredient in the appeal of a CBDC to the bank and therefore to national governments too. So what about universal basic income? I mentioned that earlier on. How might that tie in with CBDC? Well, I do commend to you a Radio 4 documentary called How Low Can Rates Go, which was broadcast originally back in 2016. Really worth listening to still, not least because of the way in which many of the things that are discussed then as possibilities are beginning to take shape around us now. So universal basic income is a form of what's known as helicopter money. In other words, money that's dropped from metaphorical helicopters onto the population by a beneficent Bank of England. And Martin Wolf, who presented this program, commented that this is a controversial idea, which until recently economists never considered a realistic proposal, so great are its risks. So the simplest form of helicopter money is the idea that independent central banks, subject to inflation targets, will make transfers directly to households. In other words, you get money for nothing from the Bank of England, potentially, almost certainly actually, in the form of CBDC if you open an account with them. And the UK Treasury would agree with the Bank of England that the bank will make an equal transfer to all households in the UK, and it has the power to do that in the quantity and with the frequency that it deems necessary. So let's think more, if that's the case, let's think a bit more about how these CBDCs might work in practice. So a central bank under government direction, directly or indirectly, could monitor all your personal financial transactions. In fact, that's a given, really. There is no anonymity with an account-based digital currency of this kind. It could also, as we've seen, impose negative interest rates on your account, which means you could log on to your account one morning and discover, that's interesting, there's less money in there than there was yesterday, and I haven't actually spent any of it. Thirdly, it could, as an extension of that, place expiry or devaluation dates on universal basic income payments in order to encourage prompt spending. And some radical economists have been very enthusiastic about this idea for some time. It's called demurrage. And in a stagnant economy where people are reluctant to spend, if you know that you can have less money in your account tomorrow than you have today, then that does encourage you to go out there and spend. Central banks could limit spending, limit my spending to certain goods and services. It could limit my spending to certain geographical locations. It could assign me a bespoke individual tax rate, or administer a fine if I've done something which is judged to merit that. It could even freeze my bank account if I've been particularly naughty. And there could be a mechanism as well to tailor UBI payments to favor certain social groups. I mean, again, you can think of some plausible reasons for that. If there's been a flood or a natural disaster or some mishaps has befallen people living in a particular town, it would be a very easy thing to do to get the central bank to credit the digital wallets of the people living in that town with a bit of money to help them through. I mean, you can see the appeal of that idea. You could also see, I think, how such an idea could be abused really rather readily, which is why people like this gentleman here, Mr. Fryman, comments that CBDCs are not just a matter of technology, but also a matter of political power and social justice. They have the potential to unleash unintended, unwanted, and unexpected societal consequences. Now you may be thinking, well, maybe they could do that, central banks, but they wouldn't, surely. Well, this is Andy Haldane, who was, back in 2016 at least, the chief economist of the Bank of England, who, as you can see there, was really quite interested in the idea that with the CBDC, it would, in his own words, provide a degree of extra potency for monetary policy to set negative rates if so required. Remember that one of the key things the CBDCs are about is about giving central banks more control over what's happening in the economy. And because the amount of cash that's circulating in the economy proportionately has dropped so low these days compared to what it was back in the 60s, the amount of direct leverage that the Bank of England now has on our monetary system is really rather limited. CBDCs could change that. Impressive looking person is Augustine Carstens, who's the general manager of the Bank for International Settlements, which, if you like, is the kind of central bank of central banks based in Basel in Switzerland. And I want to read this out to you because this is quite telling. This was in a conference that was streamed, well, exactly 2 years ago today. Regarding CBDCs, Carsten said, we tend to establish the equivalence with cash, as I illustrated earlier with those circulation diagrams. But there is a huge difference there. For example, with cash, we don't know who's using a $100 bill today. We don't know who's using a 1,000 peso bill today. A key difference with the CBDC is that the central bank will have absolute control over the rules and regulations that will determine the use of that expression of central bank liability. And also, we will have the technology to enforce that. Control is really at the heart of the idea of CBDC, for good or maybe less good. And I think we need to bear in mind the context in which this discussion is taking place. It's been a turbulent couple of years or so, hasn't it, across the world? And in fact, the 2010s were a period of quite unprecedented social unrest across the world, culminating, of course, in a lot of the responses to the measures that were taken by many governments in response to the COVID pandemic. And it's interesting that the Institute for Democracy and Electoral Assistance, in a recent report, commented that many democratic governments suffer from backsliding by adopting tactics of non-democratic regimes in restricting free speech and weakening the rule of law, exacerbated by what threatens to become a new normal of COVID-19 restrictions. Because even if those restrictions have been lifted, a precedent has been set because we've been there before, and our basic freedoms have been suspended in such an extraordinary way. It would be that much easier if sufficient reason could be adduced to go there again. And again, I think Martin Wolf saw this coming really back in 2016. He said the fact that we're even considering such possibilities as helicopter money and CBDC shows how dependent we've become on central banks as the only game in town. If events like Brexit generate recessions, central banks will start from a weak position with all conventional room for maneuver gone. They'll be forced to embark on still more experiments, and we are the guinea pigs. This is an unpredictable, uncomfortable, and unprecedented condition for our economies, with profoundly worrying political implications. It's not me saying that. It's Martin Wolf of the Financial Times saying that. And gazing, I think, rather presciently into his crystal ball. So let's move up. If this is the future of money, if CBDC, that kind of thing, is where we're headed, are we looking at a dream future or a nightmare? And if you do a little bit of a kind of scout around the internet, you will find that there is every opinion under the sun on this. Huge spectrum of opinions. So let's just sample one or two of them to finish. First of all, a witness for the defense, Joseph Huber, who's been consistently and very eloquently arguing for CBDC for many years. In fact, he's been arguing for doing away with commercial bank credit, commercial bank money completely. and replacing it with central bank money. And this is what he said back in 2020. Despite foreseeable frictions related to the coexistence of CBDC and commercial bank money, introducing CBDC is a step in the right direction. That is, pending the tidal change from bank money to CBDC. By comparison, the problems inherent in the present near complete rule of commercial bank money and other new money surrogates, by which he means Bitcoin and other related cryptocurrencies, those problems are still much bigger. It's about time to recall sovereign money prerogatives. And here's Nouriel Roubini, who we met earlier. Again, a couple of years ago now, he said this: a CBDC would amount to a financial revolution, and one that would yield many benefits. Central banks would be in a much better position to control credit bubbles, stop bank runs, prevent maturity mismatches, and regulate risky credit lending decisions by private banks. In due time, CBDC-based narrow banking and loanable funds intermediaries could ensure a better and more stable financial system. And if the alternatives are a crisis-prone fractional reserve system and a crypto dystopia, then we should remain open to the idea. But not everybody agrees. This is Richard Werner, professor of banking at De Montfort University, in a speech he gave again back in 2016. And you'll notice that for a professor of banking, he's not against using some pretty strong language. Central banks are now in the process of consolidating their powers, he says. They wish to get rid of competition in the form of paper money or commercial bank credit. They're driving both cash and bank credit out of business through their negative interest rates, which are not designed to stimulate the economy, but to create deflation and further havoc that they intend to instrumentalize to accelerate their goal of becoming the complete masters of our lives by allowing only digital currency that they issue and control, and that they can monitor in terms of all transactions, and that they can switch off if, for instance, some pesky dissident criticizes them too much. I'll leave the last word to Fabio Vighi, who is, as a professor of critical theory, takes a kind of a broader perspective on these matters. As public debates are silenced by censorship and intimidation, we're being escorted into a biotechno-capitalist dystopia whose hellish character is likely to manifest itself fully with the next global crisis. And this would justify the rolling out of CBDCs. Digital cash linked to digital identity is shorthand for high-tech monetary serfdom, which will be extended to the unemployed first, UBI recipients, and potentially to most of us. Well, of course, UBI, by definition, eventually would end up in everybody's pocket. When Larry Fink, who is the chief executive officer of the asset management giant BlackRock, when Larry Fink says that markets prefer totalitarian governments to democracies, we should better believe him. So finally, where's the faith been in all that? Did you spot the allusions to it that emerged along the way there? Well, I think I spotted about at least six allusions. So the first one has to do with the fact that in a debt-based system like ours, money is created out of thin air. So in effect, what we're dealing with here is faith in something that doesn't yet exist, which is pretty kind of metaphysical, isn't it, really? But that's at the heart of what money is in the kind of financial system that we've evolved since the 17th century. Secondly, I think with fractional reserve banking, we're talking about faith that your money will be available when you want it. That, of course, is what the customers of Northern Rock back in 2007 lost. They lost that faith because they started queuing up outside their local branch to get their money out, effectively to exchange their deposits in Northern Rock for the IOUs issued by the Bank of England in the form of notes, which, of course, they just did still have faith in. That's the point there. But believing that your money will be there when you want it, again, is fundamental to the way our system works. And thirdly, faith that your money will be accepted in exchange for useful things. There has been countless examples through the history of finance across the world where currencies have lost their value because of runaway inflation. Typically, even a wheelbarrow load of money couldn't necessarily buy you a loaf of bread at times in Germany in the 1920s, for example. And again, in Argentina more recently, to just clutch one example out of thin air, that's been the case. So the faith that your money will be accepted in exchange for useful things is something that we should take quite seriously, I think. And finally, or rather to continue, faith that an economic system based on interest-bearing debt can continue to grow forever. I mean, that's an enormous step of faith, isn't it? Because endless economic growth seems to be predicated at the very basis of this debt-based monetary system. And related to that is faith in financial and monetary innovations, which are claimed to enable the system to continue. So things like helicopter money and UBI, the latest bright idea that some bankers come up with as a way of trying to stop the house falling down, but as a means of somehow propping it up open-endedly into the future. Do we really believe that these instruments, however ingenious they might be, are going to guarantee the future of the system indefinitely? And finally, I do think that if the future of money is as I've sketched it today, then that does also require a step of faith, a faith that this great reset isn't going to go totalitarian. Given the way societies across the world are these days, there's the febrile atmosphere that's been engendered, particularly since 2008, and has taken various forms as different historical circumstances have developed. So I wonder how you got on. Did you spot those? Maybe you spotted some other faith commitments implicit in some of the ground we've covered. Of course, Jesus talks a lot about that, doesn't he? He talks a lot about money. And in a way, it's all wrapped up in that verse from the Sermon on the Mount there, where your treasure is, there your heart will be also. Jesus seems to have understood implicitly that our faith in God is largely mediated through the implicit faith that we have in the people and the institutions around us. To the extent that we have a choice in where we place faith, an interesting question therefore becomes, how far does the way I've placed my faith in human institutions and human beings, to what extent does that reflect the fundamental faith in God which I profess? It may do, it may be congruent with that, or it may not. And I think considerations like these begin to sort of tease open some of the issues that are related to that. So thank you for watching. That's the end of the presentation. Do feel free to email me if you want to kind of interact on this further beyond this evening. And as I mentioned, if you want to get hold of the PDF of this presentation, and I think in due course as well, a recording of what's transpired this evening, then go to the Join Enough homepage and you'll be directed, I think, fairly straightforwardly to where you need to go. I'm going to stop at this point. I'm going to stop sharing my screen. Okay, so I believe that John's been collating some questions.
Well, we haven't really got any questions yet. I can see that Colin has got one. There may be, and Kathy. Let's hear from them face to face. It's if others could put questions on chat, it's easier to monitor because it's a bit difficult to see everyone. So Colin, you're first, and you've unmuted. So question to John.
Yes, thank you, John, and thank you very much, John, for your presentation, which is very interesting, and your references, although you didn't make it explicit, to some of what we read in the book of Revelation about the rise of the totalitarian state in the end times. Now, I'm not actually going to go there. I'd like to actually go back to the Old Testament, because you didn't mention the subject of the charging of interest and whether it is actually moral and ethical or not. Now, there's a question that interest may or may not be real because of inflation, but let's think about the charging of a real rate of interest. So in other words, the bank gets more back in real terms than they've actually created through this magical money creation process of endogenous money that you described. Thomas Piketty, who wrote a famous and terribly long book that I haven't yet managed to get through, makes clear that if the rate of growth is less than the rate of real interest, the banks end up owning everything eventually. So we all end up, in complete serfdom, as you just described. Is that actually a secular person's proof, as it were, that the Bible is right, that he who charges in usury shall not ascend the hill of the Lord?
Thank you, Colin. Good to see you, Colin, again. We had a bit of a chat in Birmingham, didn't we, a couple of weeks back? Yeah, so interest is a really interesting, forgive the pun, issue to deal with, isn't it? And it isn't just in the Old Testament that interest gets a rough ride. I mean, Aristotle, for example, had no time for interest either. I mean, I think the key, you have to ask the question, how did interest come to be levied, not simply as a way of exploiting those who are short of money, but a way of actually enabling commerce to happen that wouldn't have happened otherwise? And again, if we go back to the 17th century, as I understand it, I mean, there was a huge demand for money at that time from people who were keen to exploit, on the one hand, the fruit of the agricultural innovations that had taken place in England over the previous century, and also the opportunities for profit from trading overseas that had opened up following the discoveries that had taken place a century or so previously. Obviously, the discoveries of the Americas, but also new trading routes into the Far East. And at that time, in the 17th century initially, the only thing that passed for money, as far as merchants were concerned, was hard cash. It was silver and gold. And there's only so much silver and gold to be had that you can make into coinage. So there was a huge dearth of credit to enable some of the commercial enterprises that merchants wanted to embark on. There was a dearth of credit for them; they couldn't do it, and so the advancing of credit on interest kind of made sense. There was a kind of win-win logic to it in that context. And of course, what's happened since is that kind of, if I can use the C word, that kind of capitalist dynamic of money accumulation and reinvestment, and that sort of idea of perpetual growth has gone from strength to strength. And it was, of course, the industrial harnessing of fossil fuels in the 18th and 19th centuries that made that kind of take off into the stratosphere in a way that could never have been anticipated beforehand. The reason, as Piketty and others have highlighted, the reason interest, I think, is problematic now is because essentially the economy has stopped growing. The whole model of interest-bearing debt as a way of enhancing the economic prosperity, not just of a tiny elite of merchants, but of the society at large, only makes sense if there are new frontiers to exploit economically and serious amounts of new money to be made. And since, well, arguably in the Western world since the 1980s, that period has drawn to a close. And the only reason we seem to have maintained a measure of prosperity, some of us at least, since the 80s, has been because of ever-increasing amounts of debt, rather than any substantive growth in the productive economy. I mean, places like China are still catching up with us, obviously. But in the West, that seems to be our predicament. So it may well be that we are, to return finally to Colin's question, it may well be that we are returning to a situation which is more akin to the world in which Jesus lived and the Old Testament prophets lived and the book of Deuteronomy was written, when interest-bearing debt was seen as inherently a bad thing. Because if you're in an economy which is not growing, which is how the human economy has been, with some rare exceptions of efflorescences here and there for most of human history, then one person's gain, if this is one person's gain, has to be somebody else's loss. And you're quite right. I mean, money tends, under those circumstances, to to congeal around those who are already in positions of economic power, because they are the ones who are in the best position to dictate the rules of the game. So I think there really is a really interesting theological and missional question to be posed by Christians here in relation to interest, and whether or not we need to recover some elements of our Christian tradition, which were, even Calvin did this reluctantly back in the 16th century. He kind of went a bit soft on interest because the merchants of Geneva were demanding access to credit, and those were his churchgoers, and they had a bit of clout. Even back in those, even John Calvin was somewhat intimidated by them. We may be beginning to return to an earlier era here, and a lot of that sort of older teaching certainly becomes far more relevant again.
Thank you, John. And Kathy, if you can unmute and ask your question, and we've got another one from Rosie as well. And I've got a couple.
Oh, hello. Well, this is very interesting. I certainly learned quite a bit, I think. I'm not sure I totally understood everything. I have never before heard of CBDC, but I have heard of universal basic income. And without any of the scary digital stuff, it's something that the Liberal Democrats have been discussing generally favourably for the last few years.
Yeah.
The idea being to give everyone a basic income. It would replace, for instance, things like universal credit. Not quite clear whether it would replace the state pension, but basically it was everybody would have a certain modest income which would help them if they were unable to work, or they, for health reasons, or because of caring responsibilities, or because they wanted to study, etc. It means everybody would have a basic level below which they wouldn't fall. So that seemed a good idea, but not if it's going to be controlled centrally in the way that Big Brother is watching everything you do.
Yeah, quite so. I mean, I think that's really interesting, and thank you for making that point. I mean, it's important for us to conceptually distinguish CBDC on the one hand and UBI on the other. It'd be quite possible, in principle, to have a UBI system in place which was doled out in cash, in old-fashioned physical cash. I mean, I genuinely can't see that happening in this day and age, but you could do that. And of course, the argument for UBI, and the Green Party again have been arguing for this for a long time, is that the economy in the long term, for it to be sustainable on a material basis, has to be smaller than it is now. We don't need most of the stuff that clutters our lives, right? And what that means is that there's likely to be fewer jobs in the way we've known them in the recent past around in the future than there are now. So what's that going to mean? I mean, it could mean that a large swathe of the population becomes quite impoverished. So the argument would be that if everyone by virtue of being a citizen gets a universal basic income, then at least that puts everyone on a level playing field. Certainly there have been some studies which have suggested that over the course of the next 10-20 years, something like a half of even existing white collar jobs might disappear because of automation. Now, you may say, that may or may not happen. We may or may not want to see that automation take place. But if that is the case, then the impact on the population would be enormous. And as you mentioned, the stigma of being in receipt of benefits would be addressed if everybody was in receipt of such an income, regardless of of how wealthy they were, of their social standing otherwise. So it's an important distinction to make that, and I wouldn't want to argue against it categorically, but it is important, I think, to be aware of the possibilities that exist if UBI is introduced, as it almost certainly would be, I think, in practice, in this day and age, via a digital means.
Right. There's a question from Rosie, and I'll add a little bit to it. Her question is, am I right in thinking that it was only relatively recently that the government freed the Bank of England and allowed it to operate independently? And I believe that current government is considering reviewing this. So if that's the case, could you comment on what might emerge if the Bank of England was under political control? And perhaps my question in addition to that would be, what practical steps has anyone taken towards the introduction of CBDC? I mean, to what extent is this an active option that's discussed with politicians and a really clear policy option?
Yeah. So to quickly answer that last question first, John, if you go to the PDF version of my presentation, there's a little kind of addenda section of slides at the end there, and I've included some further references to sources that talk about CBDC and UBI. And if you go there, they'll give you a far more comprehensive, up-to-date picture of where things stand with it. And what I would say is that the CBDC agenda is very advanced in certain places, including India. Intriguingly, they have this digital ID system that's been rolled out in India. I mean, having lived in India briefly back in the 90s, I can scarcely believe it, but they have done it. And that's basically puts a framework in place for the introduction of CBDC quite readily. Let's go back to the first question about the Bank of England's relation to the government. I think in every country, the relation, even where there's a written constitution, which we don't have, obviously, there is a somewhat ambiguous relationship between the national government and their central bank. Notionally, the banks are all meant to be independent. In this country, the Bank of England was actually nationalised by the Attlee government after World War II, but nonetheless is supposed to have retained a notional operational independence. And of course, back in 1997, when New Labour got in, one of the first things that Gordon Brown did was to relinquish any influence, ostensibly at least, on the setting of interest rates. And you'll know that at the moment, interest rates, which have been one of the main tools available to the Bank of England up until now to impact our monetary system, the base interest rate has been the lever that they've had at their disposal to do that, and the decisions made by an independent committee of technocrats, effectively, that meet every month, every quarter, I'm not sure, to review the interest rate and act on that basis. Now, the reality is, though, in this country, Parliament is sovereign, right? So what Gordon Brown bestowed on the Bank of England, a future chancellor could just as easily take back. And one of the really interesting questions, if you chase up the Joseph Huber references there, the guy who was a big advocate of central bank digital currencies, one of the things he talks about is how you would go about deciding how much money there is in circulation. Up until now, nobody's decided, because it's been in the hands of commercial banks who've just made loans in order to make money through the interest. Now, if you stop commercial banks doing that, which is what people like Huber want to do, and the organization Positive Money, and all the money in circulation is generated by the Bank of England instead, now how do they decide how much money needs to be in circulation? So Huber argues for basically a changed role for the Monetary Policy Committee that currently sets interest rates. Others, including the ecological economist Herman Daly, who many of us will have maybe come across, I think rather more shrewdly said many years ago when he was discussing this himself, actually this is inherently a profoundly political decision, And you can't just leave it to a bunch of technocrats, because they're going to have to weigh all kinds of different factors if they're trying to decide whether to, you know, accelerate the printing presses or drain more money out of the economy. And so you would need to have some kind of government involvement in that, and some kind of parliamentary oversight, at least, of the way that committee operated. And I think, I mean, on the face of it, I think there's a really strong a priori argument for Hoover's position about introducing sovereign money and just taking this crazy debt creation machine that's got hopelessly out of control in the hands of commercial banks, closing that down. You can see the argument for that very clearly, I think. But as is often the case, the devil is in the detail. And it boils down to, do we trust our government? I leave it with you to respond to that.
I think we've got time for a couple more questions. So Mark Dick is asking, what level could a global progressive wealth tax, as per Thomas Piketty, be set at to fund UBI and to reduce inequality? What percentage rate and what income group decile?
Yeah. Well, thank you for the technicality of the question. I'm going to slightly sidestep it, Mark. Forgive me, by sort of saying, I mean, I think the word global there is the most significant one. I just don't see that happening. Do you? I mean, I genuinely don't think, given what's happened since this last February, the world is unraveling in front of us, is my take on this. And we're increasingly moving into a situation where there will be, it already exists, really, of different power blocks that have got particular geographical and particular foci. So for good or ill, we're in bed with the US, are we not? So I in terms of what might happen under the aegis of whoever's running the US at any given time, in terms of presidency and people in Congress over the years to come, I find it quite hard to imagine that kind of scenario becoming viable. A global progressive wealth tax. Again, it looks really, really interesting on paper. It would make a great deal of sense.
Can I just say that was maybe a slightly tongue-in-cheek question? I was trying to sort of think about the things that would need to be in place to make it even a remote possibility. And two things I can think of would be financial transparency. That has not reached a level. We don't know, particularly with the very wealthy, we don't know who owns what or how much they own. It's all tax havens and smoking mirrors. So that would need to be fixed first of all. That's a big job of work. And then the geopolitical stuff that you're talking about is another big piece of work. The United Nations would need to reinvent itself, re-energize, and you probably need some sort of an overarching what do you call it, utopian and up in a world parliament to really enforce the rules on everybody, so we act as a global community to make a global progressive wealth tax even a possibility.
Yeah, absolutely. Thank you, Mark. That's true. And again, what you said just there again makes me think, well, yeah, at whatever scale it's operating, how far do we trust our government? Just leave that as a question to ponder.
Right. I don't think we've got any more questions in the chat. So I'll just check. No, I don't think so. So last question from me. I mean, to what extent? I find it very difficult to envisage how commercial banks would allow themselves to be essentially dissolved and sort of put out of business by a government introducing CBDCs. Is it really ever going to be likely that the commercial banks would simply sit down and die?
That's a really good question, John. And again, many other people have raised this. And I think just a few years ago, we'd have all have kind of smiled and said that's never going to happen, because that's where power is. And one imagines there are all kinds of networks that exist between the world of finance and the world of government that would make that really, really hard. But as Martin Wolf pointed out in that episode of How Low Can Rates Go from 2016, we have, and this includes commercial banks, a fortiori, we've all become dependent on central banks, the Bank of England in our case, as the only game in town. That black line in that graph, if the central banks, not just in this country, but across the world, had not intervened and put pumped liquidity into the system back in 2008, 2009, the whole commercial banking sector would have collapsed. And which would have been disastrous for us. We'd have lost our money as well, basically. We'd have gone to the cash point. No money would have come out. We'd have waved our debit card in front of the gadget in the supermarket and transaction declined. So the central banks are in, as Richard Werner is painfully aware, actually, they've got a very strong hand to play at the moment. And certainly, I think initially, the kind of scenario that people are talking about is the introduction of CBDC very much alongside existing commercial bank currencies, and they're clearly wanting to sell this as not a successor regime, but a kind of, if you like, a kind of a complementary currency to what's currently in place, introduced with a view to enhancing macroeconomic stability. And I think that kind of argument, I think the most old school commercial banker would kind of see the logic of that, given the kind of cul-de-sac that we've ended up in economically over the last whatever it is, 14 years now. But I think I mean, the politics of this is fascinating. Not politics with a small p, isn't it, really, in terms of where power really lies and where how the chips will actually fall over these next few years. Certainly at the moment, I think the Deputy Director of the Bank of England said recently he doesn't foresee CBDC being introduced in this country for another 5 years at least. But plans, I mean, clearly it's being taken very seriously. There was a big consultation last year. A House of Lords Select Committee published a report at the beginning of this year, again rather pouring cold water over the idea, saying the case has not yet been made for a CBDC. But I think, given the extent of the kind of social, political, economic unraveling that we're in the middle of, I think it'd be a brave person who said that CBDCs aren't going to be with us, maybe rather sooner than we expect, simply because they would offer essentially a rope thrown to a drowning man, potentially. And whatever, however kind of greasy and horrible that rope looks, we might all be, including the commercial bankers, might be inclined to reach out and grab it with both hands.
Yeah. Thank you, John, very much indeed for your the precision, the clarity of your presentation, and the way in which you've taken us through some very complex and, to many of us, unfamiliar issues, and made a very compelling and clear account of what the issues are and what the future might look like. So I think we're all very, very grateful to you, John, for the talk this evening.